sweet land. Oh, ah, oh, ah. May I say sweet land. Thanks, everyone, and welcome to Latitude's first conference ever in Kenya. Uh, Excited to have a really great conversation around the current economic state and looking at what VCs are looking for right now and also would be looking for in the future. So as introduced, we have an amazing delegate of panelists, investors that have been investing on the continent for well over, I'll say more than 5 years. So they have a really good perspective about the past, the current state, and also the future state of VC on the continent. So without further ado, I'll actually give the panelists maybe a minute or two to introduce yourselves, introduce your funds, and then we'll dive right into the questions. Lewam?
Sure. Thank you, Yvonne. Hi, everyone. My name is Lewam Kefela. I'm a principal at Partech Africa. Partech is a global firm with over $3 billion in assets under management, and we invest in technology companies globally. For our Africa strategy, we have about $450 million in assets under management across 2 funds. We've invested in 20 companies in Africa across the continent, across 9 countries. I'm happy to be here.
Thank you. Paris?
So good afternoon, everyone. I'm Paris. I'm managing partner of E3 Capital. We've been investing on the continent for 10 years in low carbon solutions. We have 2 funds totaling $150 million under management, so slightly smaller than Partech, but we're still there. And we invest across Africa in early stage low carbon businesses.
Hi, everyone. I'm Andreata Muforo, and I'm a partner at TLCom Capital. We're a venture capital fund investing in tech and tech-enabled businesses across Africa. For our Africa funds, we have 2 funds. We manage close to $220 million, and we invest, our sweet spot is seed and Series A, and sector agnostic, but really looking for businesses that are leveraging technology as an engine for growth and scale. It's good to be here.
Thank you, Andreata. So to kind of set the stage for the conversation, I'm going to just give a couple of points and some insight in the ecosystem and how it has looked, let's say, a couple years before, the current state, and into the future. So kind of like looking at it from the past, most people would describe, let's say, the 2019 to 2022 years as kind of like the boom time for African VC. And maybe just to give some data points from a couple of sources, between those years on the startup side of the funding rounds, we saw total funding raised peak up to $6.5 billion in 1 year. Still a debatable number, but that's kind of like the general consensus. We saw at least 750 startups across the continent raise at least $1 million. There's definitely more that have raised less than that, but I think that's kind of like one of the peak numbers that we've seen over the past couple of years. We started seeing a growth in the ecosystem outside the big 4 countries. So with a lot more markets having more startups kind of come up. So markets like Tanzania, Tunisia, Morocco, Algeria, DRC, and there's a lot more markets that are now kind of like their ecosystems are now becoming a lot more vibrant. And then lastly, between that time frame, more than 6 companies operating on the continent became unicorns. So that's kind of looking at it from the funding race side and looking at it from the operators on the continent. Now, a different perspective that I'd like to lay out as we kind of have funds or people working in some prominent funds on the stage is we've seen a number of first-time fund managers come up, raise funds, and a number of follow-on funds being raised. And I think that it's a good place to start, given that our panelists are from funds that have either raised funding during the past couple of years or some that recently raised a new fund this year. So maybe to kick it off, Andreata and Lewam, I'll pose these questions to you. Both your firms have raised a fund during the 2019 to 2022 period, right? With TLCom reaching a first close of about $7 million in 2022 of your target $150 million fund, and Partech reaching your first close at about $263 million, which was over your initial full fund target, I believe. So maybe the first question I'd like to ask is, how was it for your fund from a fundraising perspective, getting LP commitments and pretty much engaging in those conversations?
Sure, I can start. So TLCom has been operating in Africa for a little over a decade now. And when we first went to market, back in 2014, 2015, and we would show up and say, we're raising an Africa Tech VC fund, people would be like, ha ha ha, what do you really do for a living, right? It's like one investor was like, give me Africa or give me tech. Like, don't give me both in the same investment strategy. So our first fund was much harder to raise because we were one of the first funds on the continent. So when I think about that journey, so that fund was at $70 million, and now we're finalizing our second fund, which will be a little over double that size. So it's become much better. So the experience was much better in the sense that the ecosystem has developed. So you find that investors actually see the opportunity, they see the deal flow, and then also, so they understand the asset class a little bit more, not completely, a little bit more than the first time. So it took us half the amount of time to reach a final close. When I compare the two funds, and part of it, I think, is just the evolution and the growth of the ecosystem, which is quite exciting. I think also part of it is the market conditions, right? Because when we started fundraising, there was a lot more capital. Now it's slowed a bit. So it's easy. So if a fund is going into market now, it might take a little bit more time to raise. But I think at least the awareness is there.
Yeah. Thank you. Lewam?
Yeah, I would agree. I think the big benefit of raising now versus maybe 6 or 7 years ago is you have to do a lot less education around the value of the market and the opportunities that are there. I think there's a lot more awareness globally from the LP side on the value of this market. And everybody's sort of trying to bring in additional LPs outside of your standard DFIs to be able to continue to mature the ecosystem generally. I do think now, though, since we're experiencing some contraction globally across venture capital, it's a bit longer for funds that are in market right now, the fundraising timeline and period, and especially for first-time fund managers, because there's a limited track record to be able to leverage. So I think that's kind of just one of the realities of a market contraction that not only are we experiencing, but honestly, they're experiencing globally.
Yeah. And thank you for shedding that light, but then also kind of pointing out the fact of raising, let's say, a couple years ago versus raising now. And actually, in that same direction, Paris, I'll pose this to you. So having hit your first close of your newly raised fund in 2023, how would you say the fundraising landscape and experience was different now versus your last fund a couple years ago?
Yeah, I think the first thing I would want to start, whether it's the first fund or the second fund, fundraising is a bitch. It's a pain in the ass. And a lot of the founders think that we as VCs don't go through the same pain. We go through the same pain times 10. I think for us, it was a bit different, right? Our first fund was probably easier to raise than our second fund. Our second fund took quite some time. But that's probably more specific to us because everything that could go wrong in a fund went wrong with our fund. So we had to go through that hurdles and educate LPs. I think what we had going for us, which allowed us to close a fund in 2023, which is really tough right now, is the one that we had a track record of 10 years. Second is we owned our mistakes and we sold our mistakes actually, right? So a lot of times you get fund pitches would say, oh, this is what we're going to do. We're great at this. We're great at this. We did the complete opposite. This is what we did wrong, but at least you know what you're getting in bed with, right? So that helped in our favor. And then lastly, the fact that we're a climate fund really helped, right? I mean, if there's any sector-specific fund, I'm really jealous of these two because they run generalist funds. But if there's any sector-specific fund, I wanted to be in, it's climate.
That's a very good point. And speaking about the theme, the climate theme that pretty much everyone has been not necessarily transitioning to, but I think it has been at the forefront of a lot of LP conversations, a lot of DFI conversations, global conversations as well, given that we had Africa Climate Week here in Nairobi a couple of months ago. So very good point to point out. So we've heard about your fundraising side of things. So now let's talk about your investment strategy.
Right.
Right. So now also kind of like to set the stage a bit. So towards the end of 2022 into 2023, so the funding landscape has changed, as you've all kind of mentioned, based on your fundraising experiences. So with the global African tech ecosystem being in what people have now coined the funding winter, one of the main indicators of this is the funding raised, right, by companies. And just to give a little data point, so according to the big deal, only 2.6 billion in deals have been tracked in their database at this time of the year, that's as at November, compared to 4 billion last year. So we can see that that's a huge difference and also a huge gap. So maybe to understanding a little bit better, and this is for all of you, first question I'll ask is, what would you say are the continent-specific factors that are making it harder for African companies to access capital today compared to a year ago?
Sure, happy to go. So I think there are probably a few challenges. One being the first being the perception of risk, right? And the and then also when you think about who is investing, it's people from the West, the U.S. or Europe, and many people don't know, they don't understand Africa, and Africa is not a country. So there's also a little bit of that. So there's a bit of education that goes with understanding, the different markets, and then the perception of risk that's associated with that. I think that's the biggest challenge that I see that companies face. Then the second is just the fact that it's an early ecosystem, right? So people or investors also ask, like, can I exit? So yes, I've deployed my money in there, but can I get my money back out? And who will I exit to? So that's a question that they have. Or will they be co-investors? So as a company is growing, will there be other investors that can, if it needs capital to grow, will there be other investors that can come on board as well? So just the fact that it's a nascent and earlier ecosystem when you compare globally makes it challenging. And then I think maybe the final thing I would say is, I think the other piece about the businesses that we see in Africa is they're also a little bit nuanced in terms of we're operating in a market where the infrastructure is not as developed in some spaces. So you find that whereas in the US, you can just have a software company and you're good to go, off to the races. Here, maybe you actually need to do the logistics. You also have to do the distribution. So you're doing much more than your typical startup in a similar space wouldn't have to do. So just getting investors to also understand that who are not in market can be quite challenging.
I think if I have to add something to that, I think those are all excellent points. The other thing to kind of keep in mind is, like, we're not going through a market contraction in isolation. There's a market contraction that's happening in VC and tech globally right now. So we're seeing funding levels across the world drop significantly. We're seeing a lot of company restructuring. We're seeing a lot of companies die, unfortunately, because we've been in this bull cycle and globally now are experiencing a correction. Because in Africa, we participated in the bull cycle with a lot of foreign capital coming into the market aggressively. Now we're also sort of participating in the correction, which is fine and honestly expected. I think, to me, maybe to put a little bit of a positive spin on it, one of the more reassuring things is right now we have more Africa-focused and dedicated funds than we have before, between us, 3 on stage, and a few others that are holding significant AUM and capital that's earmarked just for Africa. I think that's one of the things that is a little bit more inspiring to me in this correction, that there is money that is looking actively on this market and focused on this continent more than ever before.
Yeah, I think that, a lot of what I was going to say has been captured, but the only one thing that I would add is there's a realization that now, 15 years on after, VCs, it's a very new asset class in Africa, right? With VCs really just taken off in the last 5 years. And now we have the data to back it. So all the dreams that VCs and founders were selling to their investors, there's a realization, okay, that's not happening. And how do we ensure, and this is an ecosystem as a whole, and us VCs have a part to play in it. How do we ensure that we're not copying Western models in Silicon Valley or Europe or even in India and Asia, and basing them in Africa, because it's completely different. I mean, it starts even from founder expectation, growth expectation, valuations. I mean, the valuations are absolutely insane historically, right? And then to Andreata's point around exits, right? We're not going to get the exits we see in Silicon Valley or in Europe. So we need to start from the end point and work backwards. And again, also because capital is scarce in Africa, we're not going to raise the Series A, B, C that we see in the West. So how do we more focus on unit economics, quality of growth instead of quantity of growth? And that's really one thing we're now coming to realization with.
Yeah, no, a very good point. And thank you all for the different perspectives that you shared. But that actually kind of puts us back to maybe a more personal look at your portfolios and maybe your strategy this past year. So we've kind of talked about fundraising. We've kind of talked about the difference, or let's say the changes in terms of how the venture landscape has changed for companies. But now looking at it from your portfolio this past year, as we've been going through this correction, as we've clearly defined, how have the changes in the ecosystem have actually affected, let's say, your funding strategies? Did you see yourself doing more deals, or did you see yourself doing more, I'll say, portfolio management this year? And if you do see yourself doing more deals, let's say as we're looking forward next year, what are some of the specific things, which I feel like you've mentioned already, but maybe diving into it a little bit more, that you'd be looking at in companies, new companies that you'd be bringing into your portfolio versus, let's say, compared to, let's say, things that you maybe were not paying too much attention about in the past couple of years? Lewam, you want to go ahead?
Sure. So I think in 2022, we started to feel the correction. I think in 2023, we've been settling into the correction. I think some companies were maybe faster to do that than others. Some have taken a long time. So I think in 2022, a lot of firms spent a lot of time on portfolio management, trying to adjust to the shifting world. Now we are aggressively, obviously, with the funds we all have, looking to deploy and looking to invest into more new companies. What I would say has maybe shifted is in a world where capital is no longer free-flowing and easy to get, there is renewed focus and renewed discipline. Whereas before, I feel there was this distorted incentive to raise as much money as you can and go figure it out and try a bunch of things that maybe didn't earn revenue or maybe weren't super valuable for your customer, but just to have them because maybe somebody else had them. So there's a lot of lack of focus and discipline with the environment and with a lot of the companies that were in existence. To be fair, we can't blame them because at that time, capital was cheap. So it's easy to go and try everything. Now it's not. So I think one of the things we are trying to be focused on and hoping for our own portfolio and looking for in founders as well is a disciplined approach to growth, a disciplined approach to unit economics, to building, because you don't have to capture everything and you don't have to do everything. You just have to do a couple of things really well. So for me, I think that's something that I'm excited about over the next couple of years, this renewed focus on discipline and building that we're starting to see now, which is quite exciting.
Yeah, I guess from our side at E3 Capital, I mean, the first fund we're actively doing portfolio management, and then that often means cost cutting, focus on unit economics, driving really sustainability of the business, or focusing on bottom line, and strategizing around that, which is very hard. I think for the second fund that we've just raised, I think what we are actively deploying, and we're lucky and fortunate to come in at a time where valuations are subdued. So that's good. I think the one thing that we are trying to do, and the reason why I say trying, it's super difficult, but we're trying to cut our losers early on and not doubling down and tripling down on our winners. Right, and the reason why I say it's hard is when a portfolio company doesn't perform, and it's instinctively, you want to give them another chance and raise a round, but being very disciplined and cutting and not putting in good capital after bad capital is something that we're now practicing a lot more in this environment.
Yeah. Thank you. Andreata?
I think the only thing that I would add, completely agree with what's been said, is also helping and supporting our companies with fundraising, right? Because it's just a much harder fundraising environment. I think generally my sense is that in the Africa ecosystem, there's still a gap in the late stage capital, so Series B and up, because you have the funds on this on the stage, and then a few others. I don't even think they can fit both my hands. Then you're out of capital for the whole continent. So, supporting our companies in terms of connections and networks to be able to look for capital is the other piece that we've been focused on.
Okay. Yeah, I think those are really good points and really good things for founders to hear as you start thinking about raising capital in the new year and then 2024 and beyond. And maybe in the spirit of looking ahead, at what aspects of I'll say what aspects of the investment value chain in terms of the kind of companies that you're investing in and the different advice that you'll be giving companies, what pieces of advice would you give founders that are now preparing to actually start fundraising, either from yourselves or other investors on the continent or even investors globally that might be looking for companies on the ground?
Yeah, I can. So I think the first is, which is what's been said on the panel around, this is a market that rewards capital efficiency and good unit economics, right? Like make sure there's positive gross margin, because as you scale, you also scale your weaknesses, right? So you want to make sure that you're actually scaling positive contribution margin is one. Focus on building value and not just valuation, because that we saw a lot in 2022 when there was just so much capital. And I think, many companies have shut down, having down rounds and bridge rounds and all sorts. So I think you can't just focus on just the valuation, but also make sure that you're actually building and creating value there. And I think it's just like, understanding your business, the strategy, make sure you have a competitive advantage where you play.
Thank you. Paris?
Yeah, I mean, the only thing I would add to Andreata's points is around also just being very transparent around where your business is weak at, where you as a founder need help, because constantly we get, pitch day in, day out, and founders selling us a dream. I mean, we know that this is inflated. You know that it's inflated. So just also be very honest with where you are in your business, why you need us. And also, I think that the founders, there's a correlation between the founders that we've backed that have done really well and performance, and that is founders doing due diligence on investors as well. So as founders, as much as we do due diligence on you guys, you should do due diligence on your investors.
Yeah, it's a very good point.
Very good points. I think the only thing maybe I would add or focus on a little bit is, so we invest in like seed plus to Series C. So we're usually not the first institutional investor. If you raised around in like 2020, 2021, and maybe the multiples look different today, I think there's still a lot of companies that are going to go through that first adjustment to where the market is today. And what I've seen is the strongest founders recognize the shift in sentiment and adjust. And the founders, to Andreata's point, that are optimizing for valuation, which we can't totally blame them because that's all they know. They raised in a bull market, but those are the ones that will struggle over the longer period of time because the market has fundamentally shifted and it's not going to shift back in the same way and at the speed that you would anticipate. So my advice would be adjust. We're all going to take a little bit of a bullet, but it can really help you transform the trajectory of your company going forward to take into account where the market actually is today.
Yeah, and one thing I like saying to your last point, a down round does not necessarily mean a bad round.
Yes, absolutely.
Okay.
I think maybe just one final point for myself is that, the conversation may seem a little, and as you read the news, right, it seems a bit doom and gloom in terms of the capital markets, but I think the funds here and there are other funds that have raised capital, so we're actively investing.
Yeah.
And our capital is earmarked for Africa. So we're actively looking for investments, and we take a long-term view on investing. It's a couple of years out. So yeah, we're excited for entrepreneurs who are continuing to build. And I think also the entrepreneurs that survive this period are pretty resilient and are probably going to be strong because you know the strength of your army after it goes to war. So you've gone to war, so we're excited about that.
Yeah.
So if we don't already know you, reach out to us.
Yeah. So I hope you guys have heard. If there are any founders in the audience, these are investors that are actively deploying. So definitely reach out to them, and there are a number of them out there. So don't hesitate to actually fundraise, thinking that there's no money out there. And I hope you got some great tips from our panelists who have shared their insights on both the investment landscape and how their own investment strategies are shaping up now and then also into the new year. Thank you.
Thank you so much.
Yeah. A round of applause for our panelists, please.